All right, we're going to jump in and get started. We've still got a few folks being admitted, but thanks for being with us here on a Friday. I want to do some introductions around the room before we jump in, and then we'll go to the screen. I'm Samantha Storms, the Division Chief for External Affairs for the BLM Fire Program here at NIFC. So when you hear external affairs, think all things internal and external communications, trying to tell the BLM Fire story, and your host of Fire Chat Friday. We'll go this way.
I'm Jennifer. I'm the admin of FA 200 Support Services.
Hello, everyone. I'm Eileen Wallace. I'm the Equal Employment Opportunity Manager for BLM Fire and Aviation. Sit here at the Fire Center and happy to be here. Thanks.
Good afternoon, Molly Anthony. I'm the Division Chief for Fire Planning and Fuels Management.
Good afternoon. I'm Brian Oxier. I'm the Division Chief for Fire Operations.
Good afternoon, Bodie Ronk, Division Chief, Support Services.
Good afternoon, Ben Sitz, Budget Analyst, FA 400, Budget and Evaluation here at FA.
And also one of our panelists for today's Fire Chat Friday. We'll kick it over to our other panelists. Brock, we'll go to you.
All right, Brock Uhlig. I'm the State FMO for BLM Nevada. Well, normally I'm the State FMO for BLM Nevada. Right now I'm the DSD for Support Services for BLM Nevada.
And Grant, we'll go to you.
Hey everyone, my name is Grant Lewis. I'm a benefits and retirement specialist out of the NOC. I handle all retirements, disabilities for Colorado, the NOC, and Utah. Pleasure to be here.
Well, we're really excited to have this session come together. I know that a Friday can be a little tricky, and certainly a Friday in January. So like all Fire Chat Fridays, this session will be recorded, and a recording will be sent out to anyone we missed, or certainly folks who want to revisit any of the discussion. Do welcome participation from those of you joining us online. That's why we host this on Zoom. We'll get through some of the presentations from our panelists and then open it up for questions. You're welcome to put questions in the chat, but definitely encourage you to raise your hand, turn your camera on, interact with us on a Friday afternoon. And if folks have other thoughts or your own advice, you're also welcome to participate in part of this. So really excited to have you all here and want to jump in and let Grant share some expertise from the National Operations Center to get us started.
Perfect. Thanks, Sam. All right. And let me share my screen here. Okay, perfect. All right, so today I'll talk about the FERS law enforcement officer and firefighter retirements. I will hit the broad issues, the broad details of this, but for more in-depth information, we do have this particular presentation available quarterly that you guys can go into and have more in-depth information. So what I'll talk about today is the FERS retirement as regards to for firefighters. We're going to talk about eligibility, contributions, annuity, FERS supplement, and then the transfer requirements as well as military service credit. So when you look at your SF50, or in this particular case, determining whether or not you're FERS, FERS-RAE, or FERS-FRAE, it's important to know those start dates. So for FERS employees, the eligibility started before 1/1 of 2013. For FERS-RAE, that was between 1/1 of 2013 to 12/31 of 2014, and for FERS-FRAE after 1/1 of 2015. Now, the reason why this is important to understand is this is what you're going to contribute as a FERS special employee. So under FERS, the FERS contributions will be 1.3%. Under FERS-RAE, you're going to contribute 3.6%. And under FERS-FRAE, you're going to contribute 4.9%. So in terms of eligibility, for a law enforcement officer and firefighter, you will have 20 years in service and you can retire at the age of 50. If you have 25 years in service, you're going to be able to retire at any age, and mandatory retirements are 20 years in service at the age of 57. Now, there are particular instances where, let's say you come on at 38 years old and you'll have 20 years and you're at 58. Well, you should still be able to retire after that 20-year mark. So let's talk about coverages and why it's important to understand primary and secondary coverages. So primary coverage is defined as a position that's typically in a rigorous position, okay, usually in the front lines. There's a mandatory of 3 years for eligibility in that specialized retirement benefits, meaning you have to spend 3 years in a primary covered position before you transfer into a secondary covered position in order to get credit for that special retirement. So secondary coverage involves less physically demanding duties. These are typically administrative or supportive roles. So it's available right after completing the required, again, primary time, which is that 3 years. Okay. Now, primary FICA time may also be included for those 3 years requirements. So very important to understand that. In terms of transitioning to a regular FERS position, you must meet the years in service requirement for firefighter, law enforcement retirees. So that would be 20 years. Okay. You may transition prior to that age requirement if all requirements such as primary time and years in service are met. You can still retire under a firefighter requirement and may not be subject to the FERS MRA and years in service requirement. So for example, if you had 25 years in service and you wanted to leave fire at the age of 55, you could still go into a regular FERS position, right? But not be subject to that 57-year mark where you had to have 30 years. You could still retire under that FERS special guidance. So for your annuity, for those first 20 years in service, you're still going to get 1.7% for each year of service for that 20 years. Okay. Now, after that 20 years, so let's say you're 25 years into fire. Well, the first 20, you're going to get 1.7% for each year of service towards your retirement, right? The next 5 years, it's going to drop to 1%. Okay. So you go to the regular FERS annuity of 1% per year towards that average high 3 salary. Okay, so again, let's go into that a little bit further. So for each year of service, the annuity is calculated at 1% for each year of your average high 3 salary. So the average high 3 salary is the highest average base pay earned during any 3 consecutive years. Now, this could be 5 years ago. It doesn't necessarily have to be the last 3 years. So any 3-year period of time where your salary is the highest. Okay. Now, for most people, it is at the end of their career. So for each year of service beyond 20 years, again, the annuity is calculated at 1% of the average high 3 salary. So here's a little graph here kind of displaying what the annuity would be in certain situations. So if you had 20 years at 55 years old, again, you're getting 1.7%. Your average high 3 salary is $60,000. Your yearly annuity is going to be $20,400. So at 25 years at 57, and let's say your average high 3 salary is at $70,000, your yearly annuity is going to be $27,300. Employee 3, 20 years of special, and then they decide to transfer into regular FERS. Okay, so that's the difference there. They transfer into regular FERS, and then at 57, they decide to retire at 70,000. Same exact thing. So whether you stay into fire up until the age of 57 in these 2 scenarios, the annuity is going to remain the same. So one of the greatest benefits, I think, of being a firefighter and retiring a little bit early than the MRA, earlier than 57, is you get the FERS supplement. So the FERS supplement, right, it's designed to bridge the gap between early retirement and the start of Social Security benefit. It's available to certain employees who retire before the age of 62. So that's all of firefighters, right? Typically available for those who meet eligibility to retire for an unreduced annuity, and it ends at the age of 67 when eligible for Social Security. Now, the supplement is still subject to the earnings test, but here's what happens in a lot of scenarios, right? You have a firefighter who retires at the age of, let's say 53. Okay, well, from 53 all the way up until 57, that firefighter is going to get an annuity, and they're also going to get the FERS supplement, right? Now, the FERS supplement is subject to what's called the Social Security earnings test, which means for every certain amount of money that you make over, I think it's about $20,000 this year, for every $2 you make over that, your supplement's reduced by $1. So there's a reduction to it. However, that doesn't happen until the age of 57. So for that firefighter that retired at 53, you have several years where you can, if you wanted to, get another job. You're still going to get your annuity. You're still going to get the full, FERS supplement, right? Which is incredibly beneficial I think for a lot of firefighters who do retire before the age of 57. So the limit is adjusted annually for inflation. And the firefighter retiring with at least 20 years receives the supplement until the age of 62. Now I get a lot of questions sometimes that say, "Oh, well, at 62, if I decide not to take the first supplement, right, or not to take Social Security, will the supplement still progress until I get Social Security at 67 or 70 or whatever their plan is?" Well, the answer to that's no. At 62, regardless of whether you take Social Security or not, that first supplement will be gone. So a formula calculates a monthly amount mimicking what you receive at 62 from Social Security. Now we have the ability to kind of get close with that number on our reports that we run for retirement. So if you are within 5 years or so or 3 years from retiring, we can start to get you that report, kind of showing you what that first supplement and your annuity would look like. And I'll provide a contact list after this for you to reach out to our retirement specialist there for your region. So for mandatory retirements, mandatory retirement age for most is set at 57, right? So it's required to retire by the end of the month in which they do turn 57. Now there are exemptions, right, to the mandatory retirement age that may be granted in those certain circumstances, which we won't go into detail about that today. However, there are extensions up to the age of 60 that may be approved by the agency head. Extensions beyond 60 do require a presidential directive. A mandatory retirement rule does not negatively impact pension benefits. That's a key point there. So for those who have any military prior to coming into the federal government, it can be bought back. Right now, what that means is that you have a period of military service time, and this applies for military service members who aren't retired, and honorable discharge. I believe general discharge as well. I can double check on that. But you can buy back that time to put towards your annuity, right? Your FERS annuity. So any bought back time does not count though towards the special eligibility retirement for firefighters. So I get a lot of questions sometimes to say, "Hey, I got 4 years of military service here. Can I retire with just 16 years, right, of law enforcement firefighter time?" Well, the answer to that's no. Right? You still have to provide that 20 years in service. However, those 4 years will increase your annuity by whatever percentage of however many years you have for that military service, thus increasing your annuity, right? And it's highly beneficial to buy back that military time. If you'd like to or have that military time, again, I'll provide that contact list. You can reach out and we can help you along that process. So the key point about military buyback is that it must be completed prior to your retirement while you're still employed, right? There are certain situations where FICA time obviously can be bought back right after retirement, but military does have to be bought back prior to. So this does take some time. There's a lot of information we need from DFAS, estimated earnings, and then obviously processing that. So highly recommend you get started on that sooner rather than later. So in regards to benefits, and I think one of the greatest benefits of being a federal employee retiring is in fact that you can carry your health insurance into retirement with you. Now some people they say, "Well, am I going to get the same premiums? Is it going to be higher? Is the government going to pay that 70% that they do now when I retire?" So the answer there is you're going to pay as a retiree the exact same premiums as you would as an employee. All right. So fantastic benefit there. There are requirements to that. You do have to be enrolled for 5 years immediately before retiring, consecutively, that you carry the health insurance prior to retirement to be able to take that into retirement with you. FEGLI, so the life insurance. So the option to continue life insurance coverage at different rates, depending on your selection for each option. So for example, if you have basic, you have option A, option B, which is the multiplier for salary, option C, which is family. So each one of those has their own requirements of that 5 years. So let's say, for example, 2 years before your retirement, you decide to cover your family, right? You have option B times 5, about 2 years prior. Well, you won't be able to take option B into retirement with you because you haven't had that for 5 years, but you've had basic for more than 5 years, so you're able to continue basic. And again, on those reports that we run, we'll go over all of that for you. We have a breakdown of exactly what options you have, and we do a really in-depth dive of how much that's going to cost, just to kind of provide that information for you. So TSP. So while you can certainly still change your investment strategies on TSP if you'd like to move funds in retirement, you can no longer obviously contribute to TSP. Okay. So you have the options to withdrawals post-retirement. You can do a lump sum, or you can set up monthly payments or an annuity from TSP. And again, you can still move funds around as well. So we won't go over today about survival annuity benefit. Again, we go over this presentation, so we'll dive into that later. So one of the key things that can potentially delay retirement is the acquiring of the RI 20-124. Now we here will do a service credit report for you, but to verify that time, we need your local HR to complete this form, which really tells us that how many years you spent in primary, how many years you spent in secondary there. Do you meet the requirements, right, of firefighter retirement there? So this form is critical in what we do to verify that. Now, I don't want anybody to rush, if you're 10 years out right now from retirement, please don't go and request this form just yet. But if you are close to retirement, right, if you are thinking about it and getting close, I would certainly recommend requesting this sooner rather than later to get this completed. They'll upload it into your EOPF and we'll have that as a record. That way we can navigate exactly your eligibility date. So a few other small topics here. Certainly, if you're looking at retirement, it's a great time to look at the designation of beneficiaries that you have, right? So the SF3102 would be for FERS. The 2823 would be for life insurance, so who to allocate those funds to, as well as TSP. Now we here at the BLM will process the 3102 and the 2823. However, for TSP, go to TSP's website there. You'll have to go directly to TSP to update those designation of beneficiaries. All right, so FedHR is a system that we use. So whenever you call us or you email us and we start a case, this is the exact system that we're going to use to open up your case, to do your service credit, your salary history, get you those reports out. However, it's also a great tool for you to go in and have financial planning seminars on there. You can run your own retirement reports. You can speculate dates out into the future to see exactly, if you're really trying to focus on your planning there, and a great retirement information. So I will be able to get you this link here, and yeah, I certainly recommend checking that out. All right, and we'll skip that. Okay, so here are some helpful links. If you'd like to go to any of these for more in-depth information than what I provided today. All right, so you can go to OPM is a fantastic resource, obviously, for most of this, right? That's where our policy comes from. So go to OPM, look at all the retirement. If you want to dive into thrift savings plan, learn more about health insurance or FEGLI or any specific questions regarding your special retirement. In chapter 46 of the CSRS FERS handbook dives really into depth, into detail about that if you'd like to do your research on your own there. So, all right. And I'll put up our contact list here for you if you wanted to, if anybody's interested in jotting that down.
And Grant, I put it in the chat for everyone, but I'll snag a copy of the contact list and those helpful links to include in the email that goes out next week with the recording of today's session for anyone that needs that resource and didn't grab it right now.
Perfect. Thank you.
Yeah. We're going to go over to Brock, and then I really, Grant, want to thank you so much for being here with us. You obviously are a wealth of knowledge, and I think this is really beneficial for the folks online. So we'll go to Brock, and then we'll go to Ben, and we'll circle back for some questions at the end.
All right. Thank you. And yes, I want to thank Brant as well. I'm looking back in my career. I started on an engine in Wells, Nevada, on the Elko district, and the first, that was in '97. The first time that I did any kind of retirement training was after I was an AFMO, and that was 20 years into my career, and it's really, not to point fingers at anybody or anything, but organizationally, that's not a good plan. It's not the way that we need to do our retirement training. The best time to be learning about our retirement benefits is when we're first starting. And so that's a big part of the reason why I requested, I wanted this Fire Chat Friday set up so that we could learn, some of the resources that the NOC already provides, some of the other resources that are out there. Now, in my career, I was very lucky that I had fellow employees, mentors that had good advice about retirement, of making sure that I maximize my TSP as much as I can, because that's a lot of what our retirement system is based off of. And so, making sure that I get that, that full government match from the very beginning, and little tips and tricks of how to increase my investment into TSP by, when the annual pay adjustment comes in, hey, if you can put half of that, 2% raise into your TSP so that you're getting the most. It really comes down to, the earlier that you can invest, the better it is. Learning about retirement right before your retirement right before you retire is not the best plan there. And so, I was somewhat lucky to have good advice, but I truly wish that I started researching and looking into it much earlier in my career. And so, the sources that Grant was talking about and Sam will send out are great. I would highly recommend getting this book. It's the FERS Guide for Special Category Employees. You can find it on Amazon or wherever you find books. Comes out with a yearly submission, and it's it really dumbs down and gets, or maybe not dumbs down, but parcels out all those little rules and tips and tricks in there, so you can find the, do your own research and find what you need. Again, I would say, if the number one advice that I can give, and it's tough because, as a 20-year-old kid that started into this industry, retirement wasn't my first thought, but it is, the longer your money has to go into that retirement system, the more it has to do. So get your people to know at the beginning. CNIDC, it is the FERS Guide Special Category Employees 2024 by Dan Jameson. Believe they also have a FERS Guide for non-special, or for the other ones, but it's full of great info. There's also retirement trainings from the outside that can be done. I've done a couple of them. There's been great ones that I've been to, and there's been less than great ones that I've been to. But really, in all of those, I've gotten something from it. So, encourage your organization to see if they can put one on. All right. And that's really what I have in there. Sam, I'll turn it back to you guys, unless there's questions for me.
I think we'll let some folks still take it all in and put some questions in the chat, and we'll punt to Ben. Thank you so much, Brock. Really glad you suggested this, and then we'll circle back for more info at the end.
All right, thanks, Brock. And this is going to sound like a broken record from what Brock said. I brought my FERS Guide as well. I would just, the more there's lots of information out there. Everybody learns different. We can take the presentation that we just saw. You can read through this book or other guides that are online, and it just reinforces that knowledge that you're trying to acquire. Backing up a little, I am eligible for retirement and retiring in a month from now. Just looking back at my timeline, so started when I was 18, got my first career seasonal when I was 20, so super early in my career. I will retire at the age of 45. I bring that up as, like the option to like how amazing the special category is. If you don't think it's amazing, I challenge you to ask a non-special category if they will swap their retirement calculations versus your retirements from a time worked. It really is 20 years in any age or 20 years and 50 or 25 years in any age. You'd be hard pressed to find another opportunity like that. So it gives you the option too. Everybody has different situations going on, but I think just knowing that it's an option as part of your retirement package, something that you should acknowledge as a firefighter. I wrote some notes. So for me, I've been blessed with a great career, really everywhere I've been. Can't think of really any bad supervisor I've had. I could work another 12 years to mandatory. Again, I have the opportunity to retire at 45 years old with 25 years of service in, and I'm going to take advantage of that benefit. Not going to work for everybody, but I'm hoping it's going to work for me.
We'll take you back then.
My advice for employees and employees and supervisors. I went back through my SF50s this morning because I was wondering, what did I do for my TSP? I had no idea what I was filling out at the time. I was lucky enough to have the admin specialist at the time at the district I worked in Burns. She told me what to write down. I had no clue what I was doing. I looked at it this morning. She told me to put 10% in 100% in C. What she didn't tell me was don't mess with it after that, which would have been my follow-up advice for someone at this point. But, I was a GS4 at the time. I didn't even do the math in my head. I just took this lady's advice. I was making $990 a paycheck, and I chose to take out $90 of that back then. Probably if I would have thought through the math, I would have never done that. Which leads me to what Brock brought up, making those incremental changes to your TSP. This pay period we're in right now, you're going to get a 2% pay raise. If you haven't thought about it, that small little change there of taking $30 a month, you're already making it on your current, well, hopefully you're already making it on your current salary, just taking a portion of those pay raises, step increases, grade increases, up to the point where hopefully at some point you can max out your TSP. I think that is, the FERS side of it is kind of taken care of. That's based on whether you can make it to your service requirement and your high 3. That math is kind of set in stone. The TSP is solely on you and how you choose to take care of that portion of your retirement. So make sure you're looking at it. I advise, I had a conversation with someone the other day about, it's nice to talk about retirement or money with other employees. I think it's key, find a group of like-minded people and have those discussions. It's nice to bounce things off of each other. Helps dispel either myths that you had or they had. I would also put a caveat, trust but verify. I can speak from example on things I wish I could go back and would have never done based on maybe some panic at the time, I think 2008, 2001. Understand your SF50. The presentation showed the retirement code you should be in. I was in the wrong retirement for the first 2 years of my career. That issue I'm still dealing with today in filling out my service credit, right? Like there's SF50s buried 2 years later that correct that and put me in the correct retirement. So make sure you understand the retirement you should be in and that your personnel record reflects that. It's on, luckily, someone in HR at the time caught that, but really, as an employee, it's on you to understand your SF50s, your leave and earning statements, your benefits. Don't assume someone's looking out for your best interest. I had, maybe just to finalize it, I had become financially literate, especially when it comes to government benefits, but, you know, understanding these calculations that we just went through. For me, I'd seen those a few times. I think when it really hit home for me was, someone in Nevada came up with a spreadsheet that got shared to me through a bunch of different emails back in the early mid 2000s. And I was able to actually punch in my numbers in my mind, see how that affected my FERS retirement. It was just a different way. I can look at the calculation, but me being able to manually change and see what the end outcome was going to be really helped me learn. Go to seminars. We just talked about this. There's 2 seminars next week. That email went out to all BLM employees. Even if it's not specific to special category employees, I would encourage you to attend seminars. You're going to pick something up from those seminars, or it's going to raise a question for you on what don't I understand about my retirement. I said pay attention to your leave and earning statements. I wrote down, I've never seen a group of people better at tracking or accounting for their time. We know when to not take a lunch. We know our night differential hours we can get. We're not the greatest at checking our leave and earning statements to verify that. So just make sure the correct amount's being taken out. Make sure you're being paid correctly. If you read the bottom of that leave and earning statement, it says it's on the employee to verify this. I think that's what I'll leave it with. Yeah, there's a lot of tools out there. Be an advocate for yourself in learning and verifying what's in your benefits package: retirement pay, TSP, health insurance, life insurance. So.
Thank you, Ben. I'm gonna punt to Dennis Strange, our FMO for BLM Idaho. He wanted to share something as a segue from something Ben shared. So Dennis, I'll pull that up as you get started.
Hey, perfect. So, yeah, something I just wanted to share with folks. You know, I just did a quick Google to find an illustration, and Sam's going to put it up there right there. You know, the compound interest makes a big deal. So, you know, here's just a simple graph to show. You know, one person puts in 5,000 for only the first 10 years of their career, whereas someone waits until they're 35 and then puts 5,000 in for the next 30 years. And you can see the difference in what they're earning. And so, you know, I fully agree with what Ben was getting at there, is that when you start early and you know, you even do just a little amount, it really makes a big difference. And this is where a lot of people do the hand to the forehead slap when they're trying to retire, as they said, if I'd only put in $50 more every pay period, it would have made this much difference. And so if there's anything for folks earlier in their career that they really need to understand what it is, this is what I would point them to, is understanding how early contributions have immense implications later on in their career. So just wanted to share that. Thanks, Sam.
Yeah, you bet. Thanks, Dennis. That's super helpful. I do want to go through a few of the questions that came up in the chat, so I'll invite Brock and Grant back on to join us. We'll start with Wes's question, probably for you, Grant. If I retire at 50 with 20 in primary and go back as either temp or seasonal, do I keep all of the supplement? Also, can I again contribute to TSP?
Okay, great question. So to help understand this, when you come back as a retired annuitant, right? Yes, you can keep that supplement, right? That supplement's going to be there until the age of 57, right? So there's no Social Security earnings test, okay? However, it's important to understand that as you come back as a retired annuitant, there's what's called an annuity offset, right? So in other words, if you come back in, let's say your annuity is $2,000, you come back in, you're making $2,000. Well, the government does not let you double dip. You cannot get both your annuity and your pay, right? Now there's a caveat there. You can certainly get what's called a dual compensation waiver. So if your position, right, if you're what you're going in back into work is eligible for a dual compensation waiver, then you can certainly get your full pay and your annuity. Fantastic situation there. Okay. So yes, you can keep your supplement. Would you want to come back in with that offset? The other thing about TSP is if you come back under a seasonal appointment, under a FICA appointment, for example, right? Well, those aren't eligible for TSP, right? You got to be under a FERS retirement system to be eligible to contribute into TSP. So hopefully that answer that question.
Oh, yeah.
Thank you, Grant. I
So
think
Matt
this
Green
next
would-
one's a good fit for you as well. If you and your spouse are both feds, but one carries the FEHB for both, will you both have access to FEHB individually in retirement, or only the one who carried the plan during employment?
Yeah, good question. So it doesn't matter who is carrying the health insurance, right? Whether or not your spouse is and you're the one receiving the health insurance under their plan, as long as you've been covered under an FEHB plan for at least 5 years, right? You're both eligible to continue. Doesn't matter who carries it. So a lot of times in retirement, what we see is, in fact, they will. If you have a married couple, they will both go self-only for FEHB because the premiums are typically cheaper than even self plus one. So yeah.
Thanks,
Okay.
Grant. We're gonna punt one more. It's a long one to you. Is there a reference for those who may retire before 20 years to calculate what the pension would be? I know the supplement wouldn't happen, but just curious in case you have a married couple, both in firefighter retirement, but one decides to retire before they reach their 20 years. How could you calculate what the decreased pension would look like for that individual?
That's a tough one. It's really situational there. So typically, if you had less than 20 years of service, right, and you're under the age of, let's say, the 65 for that eligibility to retire after 5, you wouldn't be eligible to retire if you left. Now you'd be eligible for a deferred retirement, right, meaning that you could certainly go ahead and request that retirement at the age you're eligible with OPM. But nonetheless, if you contact your retirement specialist there, I'm sure we can work with that particular situation and give you a better, more detailed answer there.
And that's to Grant's point, where that contact list will share comes in handy, so you can have some of those one-on-one questions, but really appreciate folks' engagement here. Another clarification I think that would be helpful from you, Grant, in regards to TSP. There was a question about match the 5% for traditional or Roth. I think, most of us know that really goes into the traditional, but the follow-up clarification is putting, why the government puts that in the traditional and not the Roth.
And are those rules gonna be
yeah.
changing? There's rumors on the street, Grant, that those rules are gonna be changing.
I hope so, because God, I would love it if they would match the Roth. But no news on that. I can't provide any information on whether that's going to change soon or not, or why they do that. Unfortunately, that's not something that I can answer. You probably have to go to TSP for that specific reasoning.
Bruce, thank you. Okay, one more question, and Brock, this one might actually be a good one for you, but for career seasonal employees, how does time off impact retirement? Career seasonals often get laid off for 1 to 5 months.
So it's probably a Grant question. I can answer what I have historically known, which is if you work over 6 months, then it counts as a year. Is that correct, Grant, or am I?
Yeah. So what happens is, so obviously a lot of times firefighters take the winter seasons off. They have months, right, where they're not working. Well, what the law is, right, for leave without pay is if you don't go over 6 months, right? So for example, let's say you're on leave without pay for 5 months and you come back in. Well, you're going to get credit for all of that 5 months, which is a fantastic deal, right? So they give you credit within 6 months in a calendar year. So from January 1st all the way to December 31st, if you're off within 6 months there, you're going to get credit for that full 6 months. Now, let's say you're off 6 months in 1 day, right? Well, you're not going to get credit for 1 day, right? Which most of the time firefighters aren't really off leave without pay for more than 6 months during the calendar year. So it works out pretty well. But that's the law. So 6 months, as long as you're not on leave without pay for more than 6 months, you're going to get credit towards that retirement for that entire 6 months that you're off.
And so, I guess clarification there,
Mhm.
Our firefighters that are off are generally on furlough for the
Mhm.
winter time. Is that the same as leave without pay as
We
far
call
as
leave. We call it
retirement?
leave. Yeah, we call it leave without pay. Yeah,
Okay.
leave without pay status. So there's an action created in the SF50. They go off the rolls or leave without pay status, right? And then they come back on in pay status, right? So you guys might refer to it as a furlough, maybe.
I would just add one item on there. It is an amazing deal, right? Like you're working 6 months in a day and the government's giving you 12 months of credit for retirement. I'd say incentive to work more. Every pay period you're off, you can't contribute to your TSP. So, I mean, that's kind of the pro and con of that. But, you know, if you only have 6 months to contribute to your TSP, you might want to recalculate that if you want to add as much as you can, because you're not getting a full year's worth of TSP. This just goes up to career seasonals. I never thought of this when I was a career seasonal, but now looking back on it, or is there an opportunity to add some more money to that when I was getting larger paychecks? Probably, but I never crossed my mind.
I would also add that time and grade, you're building that, you're building your leave balances and all the other little side benefits that come along with staying employed longer.
Thanks, all. Let's go to a couple other questions in here. Grant, I think this one's a good one for you. If you're going to retire and you have over 1,400 hours of sick leave, how is that paid out or credited?
Sure. So unlike annual leave and sick leave, so annual leave is paid out in a lump sum check when you retire, right? Sick leave, the service credit of sick leave. So let's say you have 3 months worth of sick leave credit. It's added to that service credit time. So it's going to give you an extra 3 months worth towards your annuity. Okay. And so 1,400 hours, I can't give you the exact of what that would be. But if you contact us, we can certainly run the report for you and show you exactly how much sick leave hours that's going to add to your service credit and give you those numbers, right? Show you that increase there per month. So sick leave increases it, kind of slowly, steadily over each month versus annual leave that's paid out in full.
Very helpful. We've got another question here about buying back military time several years ago and have the LES statements reflecting that. Where is the actual document showing that they had military time back? Where can one find that documentation is how I read that question.
Yes. So the paid in full statements, what you receive when you do finally pay that military time back, that document should be in your EOPF. If it's not in your EOPF, you can contact us and we have avenues in which to receive that form and get that in your EOPF, because we are going to need that at the time of retirement, that paid in full statement, right? To show that you did in fact buy that military time back. So contact us. Let's get that in your EOPF if it's not.
Great. I think we've made our way through all the questions in the chat, and just want to give a continued thank you not only to Brock and Ben for their personal firefighter retirement experience, but also Grant for your expertise from the National Operations Center. If nobody has anything else for the group, I do want to turn it over to Megan Connery, our Deputy Assistant Director for BLM Fire, to share a few closing remarks.
All right, I'll give it just a hot second for last questions. Okay. Hi, everybody. Megan Connery here, BLM's Deputy Fire Director. Welcome to this Fire Chat Friday. I have to say that this particular topic jazzed me. I am not a fire retirement employee, but in a past life, I was a securities trader for Fidelity Investments prior to coming to work for the federal government. So I know firsthand that there's no substitute for time in the market, and you can try and time the market and you're going to lose. Time in the market is absolutely the best thing that you can give yourself. Little bit by little bit, as Brock, as Ben, and others have talked about. as federal employees or as a federal institution, I'll say that we do a terrible job talking with our employees about money and helping them make good decisions. I cannot agree enough with what Ben and others have said. We need to destigmatize talking about money, because getting educated is power. That is what enables you to save and move into financial security and retire, maximizing and fully understanding all of your benefits. Sometimes people choose to work with financial advisors. In my experience, a lot of financial advisors do not understand the federal system. They don't understand the three legs of the stool between thrift savings plan, Social Security, and then our annuity. So if you choose to work with somebody, make sure that you vet that carefully before you just give them your money. And frankly, I would really encourage you to try to learn what you can. That Dan Jameson book is wonderful. They update it every year. Make sure that you buy the right one. Blue for special category, red for the rest of us. But learn what your options are. Understand the difference between a Roth TSP and a traditional TSP. Very different between paying your taxes now and paying taxes later. There's short-term trade-offs and everybody's individual situation is different. But if I could offer a couple pieces of advice, it's pay yourself first. Deduct that money from your paycheck. Don't ever see it. Don't rely on living on it. Every year we get those cost of living increases, or most every year. Sometimes that's in flux and sometimes it's more, sometimes it's less. If you get a cash award, any type of tax refund, figure out ways that you can make that money work for you little bit by little bit. And make sure that you're doing everything you can to get that 5% match. That's free money that the government is contributing to your thrift savings plan. You get an automatic 1%, and then each of the next 4 is dependent upon you contributing. The government wants you to have some skin in the game, and they will match that. That is a huge benefit. Incremental changes. Again, making those adjustments little bit by little bit, finding the right balance, maybe between a Roth and a traditional. I'll also point out to be careful that you're not confusing a Roth individual retirement account with a Roth TSP. You actually have the ability, and I know sitting as a GS-15, this may not resonate with everyone, but I want you to know that you have the option to contribute $23,500 to your thrift savings plan, and you have the option to contribute $7,000 to an individual retirement account. That there's a fudge factor there depending upon your age, but you can actually do both if you find yourself in a position to do both. So get educated about the options that are out there. There's a ton of information. Be careful of folks who are trying to sell you active management of your thrift savings plan. There is a beauty in setting it and forgetting it. Learn a little bit about the life cycle funds. They tend to have higher fees and lower performance than your basic C, S, and then F and G. If you don't know where to put your money, make sure you're not defaulting just to the G fund. My stepmom was a mail carrier for 35 years. I started with the federal government, happened to go home, at the holidays and sat down with her. She was 20 years in at that point as a USPS worker. No one had ever educated her about thrift. She had been putting her money into the G fund the entire time. That is a tragedy. Don't let it happen to you, please. If you need to call me and we'll take a conversation offline. But this is where we fall down on our employees, and I'll own it. Would love to find myself in a position someday where I can change that paradigm through OPM or others. We do have those federal, we often sponsor those workshops where folks will come in from a local commuting area, and some of them are better than others. Some of them are whiz bang fast talkers that want to sell you insurance products. I would be very cautious and ask a lot of questions. Most of us are smart enough and talented enough to manage our own thrift savings plan. You only get a handful of investment choices. Educate yourself on them. C market or C fund, S fund, they're big, broad-based index funds, managed at very, very low fees. So don't pay somebody to do that for you. look at individual accounts and opportunities there. The Roth is a great deal. Tax-free earnings. You can always take out what you put in if you find yourself in a jam. Get educated on those Roth and traditional options and see what you can do. I would just say, get informed, do everything you can, and know that we are super fortunate to be working for the federal government. Pay in the industry, kind of across the board, tends to lag, maybe behind some of the private sectors. But when the economy goes up and goes down, and particularly when it goes down, it's really good to be a Fed. A lot of places do not offer that third leg of the stool, that annuity feature. So that is a lifetime guaranteed income from the time you retire until the time that you pass. So look at all of those, understand your retirement and ask questions. Start as early as you can. Encourage your people coming on to start as early as they can, because again, there's no substitute for time in the market. So there is a question that's up there about
So do you maybe want to just
matching.
clarify the 5%?
So the government will match up to 5% regardless of whether your contributions go to a traditional or a Roth. It doesn't matter which one you are electing. Unfortunately, and what we referred to earlier is the government's 5% match is only the traditional type of match. So the money that the government is putting in is traditional or considered post-tax, or I'm sorry, considered pre-tax. So what that means, Logan and others, is at the very end of the day, when you go to make your withdrawal, whatever money the government has put in to match your contributions, you will have to pay federal income tax on. The beauty of a Roth is when you take that money out, and it's true whether it's a Roth IRA or your Roth TSP, the money that you put in has already been taxed. You're taking that out. You don't owe any tax on it. You also don't owe any tax on the earnings of that money. So if you're able to put in $400,000 into a Roth TSP over time, it doubles with time in the market. You now have $800,000. You look at your TSP statement, you see $800,000. This is again, not accounting for the federal contribution. That $800,000 is free and clear your money. You do not owe any income tax on it, assuming of course that you're taking it out as an eligible withdrawal, not prior to a young age, et cetera. I hope that helped.
And the 2026 rumor, we don't have confirmation on. He's asking if TSP may allow, and that's what we were talking about before. We don't know yet.
Yeah, I don't know exactly what TSP is doing with, I've heard the same thing, that they're gonna start allowing you to convert your traditional into a Roth, but there will be tax consequences to that
There's
whenever
also-
they allow it.
Also, remember, if you're in special category and you retire earlier than 57, you still can't access that Roth TSP till you're 56 and a half. So if you're it is potentially, you should just consider that if you're gonna retire at 50 and you're counting on your TSP and it's 100% Roth. I'm not saying that you shouldn't do it, but it's all part of the equation. And then you were talking about the adding, I think maybe one of the best things the government ever did was starting in 2020, any employee hired after 2020 automatically enrolled 5%. You have to physically go in there and change your percentage from 5%. Anybody before 2010, 0. Agency contribution was 1, so if someone didn't tell you to, or you chose not to, we probably have employees out there who have never contributed to TSP, and the only thing in there is their agency match of 1%. So part of this was done to take that decision. I think a great decision by the federal government.
Yeah, that's good information. Somebody asked about whether I would, or whether we would, I guess, advise a Roth or traditional. Can advise, again, that's kind of your choice. This is what I learned at Fidelity, is never provide tax advice to anybody, because we're not in that business. We're not tax accountants. I don't see your whole situation. What I can say is the benefit of a Roth is there's no minimum required distribution. So once you become 70 and the age for MRDs changes depending upon how old you are when you were born. But at some point, Uncle Sam says, I want my taxes. You have to start drawing money from your retirement accounts, and they're gonna tell you based on your balance, how much you have to take out. And then obviously, they're hoping there's a tax consequence to that. With a Roth, there's no MRD. With a Roth, you can direct, if you wanna build generational wealth, you can transfer upon death. Your survivors or beneficiaries of those Roths can make tax-free withdrawals on that money as well. Again, particularly as somebody who has a long time to go, I think the power of, tax-free earnings is super enticing. All we know right now is that the tax law is good till the end of this year, and the tax law is gonna change. Tax law will continue to change, and, you're kind of betting on the come that future tax brackets are gonna be lower than what you may be experiencing now by deferring that. It's up to no mandatory age withdrawals from Roth. That is correct, Francesca.
So I think, keeping in line with our 1 PM end date for today's session, the whole
Sorry.
goal of Fire Chat
I guess
Friday is a candid conversation where you get an opportunity to be honest and have some open questions. And so again, a huge thank you to our panelists and folks willing to be vulnerable and share their own experiences and advice. And, hopefully for some of you, this is a continued conversation. And if it's brand new information, then I'm glad you joined us today. And I hope you continue this conversation, ask questions, lean on those points of contact that are experts at the NOC, and that information will be in the follow-up email to today's session. And we hope you have a great weekend.
Thanks.